Hi, I'm Rashmi Chaudhary, and in this video we'll discuss the statement of profit and loss. Now coming on to the basic process of profit measurement. First, you need to identify the realized revenues. Secondly, identifying the related costs, that is the expired costs that will be there in the profit and loss. And then finally, matching the identified revenues with the expired costs. The difference which you get is the net profitability or loss. Again, I specify the characteristics of revenue. Normally, revenue is generated out of business activities. Revenue results in an inflow of asset. Asset can be cash or receivables, and an outflow of goods or services. Again, it can be cash or any sort of payables. Revenue is related to a specific period. Revenue leads to an increase in the owner's equity. Further, the most important thing, revenue should not be confused with the word profit or net income, though income is used as synonym with revenue.
Is revenue generated out of business activities only?
Look dear, a business or a firm is set up to perform particular activity. Normally, the revenue is generated out of business activities. Such revenue generated from the main line of business is known as revenue from operations. In respect of a company other than a finance company, the revenue from operations is the sum of sales of product, sale of services, other operating revenues, less excise duty, if any. Further, in respect of a finance company, interest and other financial services make up the revenue from operations. Apart from the revenue from the core activity, the income can be derived incidental to the main operations and are known as non-operating income. Examples of some of the non-operating income are interest income in case of a company other than finance company, dividend income, and net gain or loss on sales of investment, etc. Hope the things are clear now.
Thanks, Shivangi.
Now talking about expenses. Expenses are incurred for the purpose of generating revenue or benefits. It is related to a particular period. However, the payment can be made before the recognition of expense or afterwards. It is immaterial. Any expense leads to decrease in owner's equity. Further, if the costs are incurred in producing the goods, unless sales are made, such costs are not considered as expenses. As soon as revenue is recognized, all the costs which went about realizing that revenue now form part of the expenses as per the matching principle. Further, Amit and Shivangi have discussed in detail regarding the financial accounting cost classification. Now let me guide you on the various measures of profit. There are various proportions of profit and loss which are addressed by separate expressions. First being the gross profit, then there is profit before interest, tax, depreciation and amortization, that is known as EBITDA margins. Then comes the operating profit. Then profit before interest and tax, that is PBIT. Now then the next level of profit is profit before tax, that is PBT, or you can say EBT, earning before tax. Then the last level of profit, the most important profitability measure is profit after tax, that is EAT, earning after taxes. Let's discuss one by one. Gross profit or the gross margins, which is the first level of profitability in the profit and loss statement. The excess of operating income over COGS, that is cost of goods sold, is called gross profit. Indian companies in most cases do not calculate gross profit. Cost of goods sold, that is the expired cost, represents the cost of inventory that was sold during a particular period. It is a part of manufacturing cost or the product cost. Now, what is manufacturing cost? Manufacturing cost per se includes direct material, direct labor and any manufacturing overhead. Computation of COGS is very complex in the case of multi-product or multi-division company. Now let's move on to the next profit, that is profit before interest, tax, depreciation and amortization, easily known as EBITDA or operating income before depreciation and amortization. It is also called as cash operating profit. As depreciation and amortization are non-cash expenses and tax and interest are non-operating expenses, profit before charging these four heads of expenses is called cash operating profit. Investors prefer EBITDA margin as it gives a cleaner view of the company's core profitability. EBITDA can be calculated by subtracting operating expenses from the gross profit plus further adding depreciation and amortization. Now the thing comes, what do you mean by operating expenses? All those expenses which are necessary to run the business or the organization, which are not directly associated with the company's output on a cause and effect relationship, are usually termed as operating expenses. Now, the next level of profitability is operating profit. Operating profit is the surplus generated by the normal operations of the company. This is a measure of operational efficiency of the company. The company, irrespective of the method of financing, earns this amount. Depreciation and amortization are deducted from EBITDA to arrive at operating profit, that is EBIT, earning before interest and tax, or you can say profit before interest and tax. Still now we have discussed operating profit. Now coming to EBIT again. Though EBIT and operating profits are used interchangeably, but there is a slight difference. So what is the difference between operating profit and EBIT? As in the previous discussion, previous concept which I told you about operating profit, I used the word that operating profit is equivalent to EBIT. But no, there is a slight difference. The revenue earned by an enterprise is usually bifurcated in two parts. One is the operating income of the business and another is non-operating income. Operating income usually refers to income derived from the main line of operations of the business. Other income usually arises from the incidental activities to the business, which has been already there. Therefore, EBIT is operating profit plus the other income. Now talking about the next level of profit, that is profit before tax, that is pre-tax profit. Profit before tax is arrived at by deducting the interest and finance expenses from EBIT. This indicates the profitability of the enterprise after charging all costs and expenses other than tax. The management has the option to finance the assets from exclusively owner's equity or with a combination of owner's equity and borrowed funds. The interest part that comes in if the management decides to use borrowed funds to finance either part or whole of the entity's asset from borrowed funds. Interest is the compensation that has been paid by the company to the lender for parting with their money for a specified time. Last and not the least, the most important profitability measure, that is profit after taxes. Profit after tax is the net amount or surplus earned by the company during the accounting period. This amount is available to the company for appropriations. That is, the amount can be distributed or dividend to the shareholders or retained in the business as retained earnings. Thank you.